a pretty broad topic. I'm going to endeavor over the course of the next hour and 15 minutes to clarify for you what the class will encompass and to stimulate your interest as we endeavor to make sense of the international monetary system, where we are, how we got there, and what the future looks like. First off, I consider all of you young global managers. You should be, for purposes of this class, a junior or a senior. If you're not, you're assuming perhaps more responsibility than you're ready for, but I applaud enthusiasm, and if you have any questions, of course, I remain available to you. What is the role of a global manager? What is a basic role of a global manager? Can someone tell me? A global manager assesses risk, absorbs a lot of information, a lot of data, and then helps either their company or their clients make decisions based upon an assessment of the risk factors that are relevant. Our objective as global managers is always to minimize our risk and to maximize or optimize our performance, whether that of our own company or that of a company that we may work for, or for that of our clients. And so as we make our way through the course of this semester, we're going to examine a lot of aspects of the international monetary system, what makes the capital markets flow. One of the things that makes the capital markets flow are moves by the Federal Reserve, the U.S. Federal Reserve. And as we said, the Federal Reserve meets 8 times a year. They met last Tuesday and Wednesday. They meet roughly every 6 to 8 weeks. Whatever the Federal Reserve does has a profound effect on the credit markets because it is the largest Federal Reserve bank, central bank in the world, with an outsized responsibility. The US dollar has a unique role in the global currency markets. Can anyone tell us why that is?
Could you?
Well, everyone's currency isn't based on our currency. It's just that in 80 to 85% of all trade transactions, the US dollar is on one side of the transaction. The US dollar is considered the world's reserve currency. You're right that we're no longer on the gold standard. That was abolished under President Nixon in the 1970s. The big problem with the gold standard is what? You need to have gold for all of your paper money. If you don't have enough gold, you can't print more money. That's a problem. You need to have the physical gold that people can exchange for their paper currency. Well, if you don't have enough gold, you have a major issue, which is one of the reasons why we did away with the gold standard. That being said, excuse me. I just lost my thought. Can someone tell me where were we?
And the Feds.
That's right, in the Federal Reserve. And so the importance of the Federal Reserve meeting next week, what the Federal Reserve did, I had asked some of you, I know that some of you watched the press conference last Wednesday. Can anyone if you're here tonight, give us some insight into what the Federal Reserve said that's so important for the capital markets?
Well, they said, sorry.
They said they won't change the rates.
They're not going to change the rates. They're going to leave interest rates low. That's the first thing, okay?
And they will keep to buy bonds.
They're going to keep their bond buying program in place. And the objective of the bond buying program is to do what to interest rates? Lower them or raise them? Keep them low, because if you keep interest rates low, that means the cost of money is what?
Yeah, inflation.
That's right. Keep interest rates low by buying bonds, because the price of a bond is inversely related to the interest rate. We're going to talk about that later in class. But the simple fact is that the Federal Reserve reaffirmed their position to provide accommodative policy, keeping interest rates low and keeping an aggressive bond buying program in place, roughly 80 or $90 billion worth of bonds every month to keep long-term interest rates low. In particular, which type of consumer is very interested in long-term interest rates? Okay, absolutely, foreign, but I should be more specific with domestic consumers.
On investors?
What type of domestic consumer is very interested in low long-term interest rates?
Home buyers?
Yeah.
That's a great answer. It's home buyers. And if you've been keeping an eye on the market, you know that the home buying market remains very strong. One of the things that's driving demand in the home market is, can anyone tell us what, aside from low interest rates, which means it's cheaper to buy, is what?
Refinance?
Interest rate.
Well, interest rates, but another condition that we're living in right now.
Inflation.
People are moving out of cities and moving
urban.
into rural areas.
Right. So there's the trend. There's the trend. The trend is that as a result of this global health crisis, the coronavirus pandemic, we're seeing a migration of urban dwellers into suburbs. So you're seeing more and more price inflation in suburban markets as more and more people take advantage of low interest rates and move to less crowded areas, because in the middle of an airborne pandemic, the objective is to be in an environment where you have more room to spread out, as opposed to the tight quarters that we often find ourselves in. We live in big cities like New York. Well, that's exactly right. And so the Fed's objectives is to keep interest rates low, to remain accommodative, not only to long-term investors, long-term business investments, but also to consumer investments, particularly home buyers who are looking to invest over the long period of time. What else did the Fed say with regard to the economic recovery? Jerome Powell was very specific with regard to what are the key factors driving the recovery. Can anyone enlighten us?
Keep printing money.
No, he said that the economic recovery is dependent upon one thing in particular.
How fast we can distribute vaccines.
Progress on vaccinations. That's exactly right. That's the big gating variable that he addressed in last Wednesday's press conference, that the single most important factor, or I'm just looking at the quote here, progress on vaccinations. He said that getting the pandemic under control, getting everyone vaccinated, getting people wearing masks, and all of that are the single most important elements to economic growth policy today. That's a direct quote from his speech last week. And no surprise, given the enormity of the pandemic, given the enormity of the consequence of the pandemic, both in terms of human life and economic activity, as I know that you're all very aware of as Baruch students. I think we covered everything about the Fed for the moment. We're going to talk more about the Fed and what its role is, and how it goes about implementing its objectives of low inflation and stable employment, the various tools in its toolkit that it can use to support economic growth and maintain low inflation. We're going to talk more about that in our next couple of sessions. Before we move on to the slideshow, let's talk about recording the class. I don't have any objection to recording the class. Last semester, some objections were raised by some of the students in the class, and we didn't record the classes. As a result of that, I got some feedback at the end of the semester from students who pointed out that sometimes their internet connection isn't where it needs to be, and they might lose the connection during the course of the class, and they really need to have the recording available to them. With that in mind, and my objective to always be as cooperative with my students as possible and make available to you all the information that you need to succeed, I'm perfectly willing to record the classes and make them available to you after each class session. I'm not recording tonight's class because I wanted to give all of you that are listening to me this evening a chance to think about that. And if over the course of the next 2 days, nobody comes back to me with any outstanding reservation or objection to my recording the classes, I'm going to start recording the classes and then make them available to you. But just for the first night, in anticipation that there might be someone who does have an objection but doesn't want to raise it publicly, you have the next 2 days to raise it publicly with me. Of course, if objections arise during the semester and we've started to record, we can revisit this, but I see that we can do a quick poll. I'm not inclined to do that, excuse me. I'm not inclined to do a quick poll. What I'm inclined to do is to have the first class tonight move along as it's moving, and to give students the next 2 days to get back to me with any comments. presumably, if there are any comments, we'll cross that bridge when we get to it. If there are no comments, we'll continue proceed with recording the classes, and I will make them available to you after class. In addition, after every class, I will make available to you the slideshows that we do that evening. I work on the slideshows the day of every class, therefore I don't provide them with you in advance. That being said, you have all of the reading assignments that have been provided for you in the syllabus. I'm going to encourage you to do all the reading ahead of time so that you're well prepared to participate in class. So for example, right now, you should all be reading chapter 1 of the textbook, which is Corbo's book. I don't know if you can see it on my, I think there's maybe a little, yeah, no, we got some sketchy stuff going on there. But it's Corbo's International Economics, 15th edition. I've even went as far as providing you with a PDF version of the book. It's on Blackboard. We're going to communicate on Blackboard throughout the semester continually. It's going to be the conduit through which I give you all the information we cover in class, additional or supplemental support material on various subjects that we're going to cover over the course of the next number of months. I'm going to leave it right there. Are there any more questions about recording or comments before I move on, or about the Federal Reserve? Anything else I mentioned? Okay. Under course documents, sure, under course documents, you should have the syllabus and some market information that I gave you, sure. Right. It's under course documents, it's absolutely there. There should be two, there should be a copy of the syllabus and there should be a copy of the PDF of the book. I'm gonna post for you a copy of my attendance sheet. Take a look at that on Blackboard. Make sure that your ID number and all the other relevant information, your contact information is all correct. If there are any comments on that, please come back to me. Please come back to me. Oh, look, there are some more people. Please come back to me with any corrections that need to be made. So again, chapter 1, you want to get reading, you want to start reading that, and we're going to cover that over the course of the next couple of weeks. We're going to spend the next few weeks talking about the capital markets to make sure that we're all on the same page with regard to the basic elements of what drives the capital markets, the international monetary system, such things as the Federal Reserve. When you come to class each day, you should be prepared to talk about something to do with the capital markets that day. So we saw that the Dow ended up a few hundred points today. Can anyone tell me what accounted for the positive market sentiment today in the Dow? Any comments?
No, it was because of the sell-off of last week. I think because of all the GameStop and AMC of Reddit, the market was pretty afraid from all those short squeeze.
Sahar, that's right. Yes, the short squeeze though seems to be off as of today. GameStop seems to be price seems to be coming back to earth. The market has shaken off some of the short seller jitters. The overwhelming theme of today seems to be what? We have to remember that there's a direct intersection between politics and the capital markets. And so the announcement of bipartisan discussions between the Democrats led by new President Joe Biden and the Republican caucus, or several members of the Republican Party, of course, was taken as a positive by the markets, because the markets expect what? The markets are expecting coordinated fiscal and monetary policy that will support the economy. Well, we know from Jerome Powell last week that the Federal Reserve is going to do its job with regard to monetary policy, with regard to fiscal policy. The closer we get to a deal to provide another stimulus package for COVID relief, that the Democrats are asking for upwards of a $2 trillion package. That's going to be received very positively by the capital markets, which are always looking ahead. The expectations are for the future. And so if you inject nearly $2 trillion into the economy, what does that act as? Does it act as a negative spending shock or a positive spending shock? That's a rhetorical question, because of course it's a positive spending shock, because what will people generally do when they get that stimulus check? They're going to spend that money. That's going to lead to more economic activity, and that supports the recovery. So that's a major positive in the market today. The other major positive in the market today is encouraging news about progress on the vaccine front. Are there any other comments about market sentiment today and what drove it? My position is that oh yes, say buy more Tesla options. Okay. No, I'm sorry, someone jumped in with a note there. My argument is that it's bipartisan negotiations on the Capitol with regard to a targeted coronavirus stimulus package, along with positive positive news about the vaccine. Is what's driving positive sentiment today on the markets. Okay, anyone want to add anything to that? No. Okay, so I'm going to jump in. I'd like to share my screen with you, everybody. Let's see if I can get that done correctly. Let's start with a slideshow. Okay, so all right, so you're all in there. Typically, I'm going to introduce the class, and we're going to talk for a few minutes, and then we're going to go through a slideshow. If we were in school, in a classroom at Baruch, I'd be doing exactly the same thing. We'd be interacting in class. We'd be discussing the day's relevant geopolitical, economic events of the day, and then we would proceed with whatever the course lesson was for the evening. I'm going to do the same thing here as I did last semester in our online course, and in the spring of 2020, when this whole first thing got started in March of 2020, last spring. So with regard to the slideshow, as we move through the slideshow, if you have questions, my comment earlier in the class still holds. Throughout the semester, I'm very informal. I want you to engage with me, engage with each other, have a discussion. If any questions come up or something isn't making sense to you, please do not hesitate to unmute yourself, participate, make your comment known. Following that, of course, after every class, you're welcome to share comments with me, and I will respond to them immediately if anything comes up. So what are we looking at here? We're looking at a map of the world, and it shows you the various economies broken down by size, give you an idea of the scope of the global economy. Here we see the top 20 largest economies, from the US and China all the way down to Switzerland, Saudi Arabia, and Turkey. I thought it would be interesting. Let's take a look here, and we see here the 20 biggest countries. We see their GDP, and we see the region in which they're in. Excuse me. Okay. We see the size, the GDP, we see the per capita income, and then we see the region. And if you notice here, I put in the fact, I wanted you to see that you've got your top 5 economies, US, China, Japan, Germany, that California is effectively after the UK, California is the world's largest economy, which is why California, as the almost 7th largest economy in the world, has such an outsized degree of importance, both politically and economically. Now, if you look at this chart, what we're seeing is we're looking at top trading partners, the United States, in 2017, and you see on the top line here, the total exports were 2.3 trillion, total imports were 2.8 trillion and change, for total trade of 5.2 trillion. The top 15 countries, exports and imports represented just under $3 trillion of total trade, or about 56% of trade. In 2018, what happens in 2018? We see that, again, going back to 2017, the total trade went from 5.2 trillion to 4.2 trillion. Total trade with the top 15 countries went from 2.9 trillion to 3.5 trillion, with all the various imports and exports for each country broken out below, which we don't need to go over right now. It's the top two lines I'm concerned about at the moment. What happened in 2018 that took a big chunk out of global trade for the U.S.?
Trump's trade war.
What's that?
Trump's trade war.
That's right.
Yes.
The Trump's trade war. That's exactly right. So we saw a punitive trade war enacted that imposed tariffs and other non-tariff barriers on countries all over the world. So the U.S. imports a lot of aluminum from China. And so if there's a tariff on Chinese-made aluminum or Canadian-made steel, from which we get most of our steel out of Canada, what happens to the price of all the various products that use aluminum and steel in their production, whether it's
Increase.
That's right. So that's exactly right. So a tariff is a tax. Non-tariff barriers like such things as quotas, for example, also act as a tax. We're going to examine the welfare effects of those tariffs and non-tariff barriers later in the course, but you're exactly right. The Trump trade war, which was driven, a tariff-driven trade war, was driven by Trump's desire, President Trump's desire to punish various countries. Unfortunately, the punishment imposed on other countries came right back to bite us, as we saw countries like China stop importing agricultural products out of the United States. So if the U.S. imposed tariffs on Chinese-made aluminum, which drove prices higher on products that use aluminum, whether it's trucks or beverages or soda cans or all the things that use aluminum and steel in their production. At the same time, the price of goods manufactured here in the United States that use those inputs to production that are sourced from other countries like China and Canada saw their prices increase, whereas countries like China, which are, they know what they're doing. Their exports are facing higher prices in the United States. So that leads to not only higher prices for U.S. consumers of Chinese-made aluminum, it leads to a fall off in exports of Chinese aluminum to the U.S. because it becomes too expensive. At the same time, China did what? China stopped buying American soybeans. American soybeans is a $12 trillion market in the $13 billion market in the United States, representing hundreds of farmers and thousands of jobs. Well, China is the largest consumer of U.S. soybeans. It buys about 98% of U.S. soybeans. So if China decides to stop buying U.S. soybeans, what happens to the U.S. soybean market, folks?
Goes down.
Plummets.
It plummets, it collapses, which is exactly what happened. The U.S. soybean market collapsed. So that's another example of a trade war gone bad. As you remember, President Trump said trade wars are easy to win. Your first lesson in ECHO 3250, International Finance and Trade, is that trade wars are not easy to win. Trade wars are very difficult to win. The problem is, I put a tariff on your goods. What are you then going to do?
Do the same.
You're going to put a tariff on my goods, because what do we have then? We have a retaliatory tariff-driven trade war, which is exactly what we got. There are no winners in trade wars, which is why we try to avoid them. The thing about trade, though, is trade is great, because what does trade do? Trade allows us to strengthen the forces of reform. It allows us to strengthen environmental and labor rights, to support real and intellectual property rights, to encourage greater increased productivity, and to encourage higher living standards around the world, which is what we've been able to do over the course of the last 75 years, with the U.S. in charge of devising trade rules for the modern world. The problem that we saw under the last administration is that when the U.S. takes a step away from its leadership role in global trade, that creates a lot of problems. It creates a vacuum, and in that vacuum, who steps into that vacuum if the U.S. steps away from its leadership role with trade? Excuse me?
Could you repeat the question?
Steps away from its leadership role, for example, withdrawing from the Trans-Pacific Partnership in Asia. Who steps into the vacuum when
China.
U.S. leadership takes
Other
a
countries.
step back.
Other
Other
countries.
countries, but in this case,
Europe.
I would say Russia.
Yeah, usually it's the
China.
absolutely.
China.
China, of course. If the U.S. is not going to model trade for Asia in the 21st century, the world's most important economic region for the 21st century, who is going to model trade for the region? It's going to be China.
Yeah.
So if the
And
U.S. is not,
India, they are a very big player in the
India is also a very
economy.
big player with an emerging middle class. China and India are two major players. I'm thinking specifically about the Trans-Pacific Partnership, which the U.S. took 7 years to negotiate. It would have eliminated more than 18,000 tariffs on various goods across all of the member countries, the 12 member countries of the Trans-Pacific Partnership. Just to give you an example, Vietnam, which has 90 million people, has tariff rates up to 70, 75%. This is a market that U.S. car companies would like to be in. Tariffs on American-made cars, tariffs on cars coming into the United States, tariffs are relatively low, about 2%. That's because of a lot of bilateral, multilateral trade agreements that the U.S. maintains with countries around the world. Well, Vietnam and Malaysia, these are countries with growing populations, growing middle-class populations with consumers that want American-made products, but there are very high tariff barriers to get into those markets. There are very high barriers to entry. And so the Trans-Pacific Partnership would have eliminated all of those barriers. By pulling out of that, China steps in with its version of the Trans-Pacific Partnership, which is the Regional Comprehensive Economic Partnership, and that's China's version. It's RCEP, which is China's version of the Trans-Pacific Partnership. Unlike the Trans-Pacific Partnership, it doesn't raise worker standards or environmental standards. It doesn't protect or support intellectual property rights. Its view towards trade is more of a mercantilist, statist view, as opposed to the cooperative international view that was advocated by the U.S. as the chief architect of the Trans-Pacific Partnership. So we see here that between 2017 and 2018, U.S. trade fell off dramatically as a result of the Trump tariff war. If we look at 2019, you'll see that trade remains off of its highs in 2017. And now if we look at 2020, you see that the total for all countries, this is through November, is 3,420,000,000. The total of the top 15 countries is 2.5 trillion. Nothing much has changed over the course of the last 4 years, 17, 18, 19, 20. If you look here, what do you see? You see the 4 years broken out. You see the top year here, 2017, before the trade war, where we were in terms of total trade and where we are now in terms of total trade, right? So we went from 5,224,000,000 to 3,420,000,000. Now, if we take that, that's through November, that 33,420,000,000 at an annualized rate, SAAR here, means seasonally adjusted annual rate, has 30% off of our 217 number of 5.2 trillion. This is the impact of that trade war, a tremendous contraction in the size of overall trade. And you'll see that where are we in terms of our dependence upon those top 15 countries? Well, we're higher than we were back in 2017, and we're about where we were over the course of last few years. What about trade with China? Well, if we go back to 2017, trade with China was 636 billion, 18 was 660 billion, 19 was 559 billion, and 2020 through November was 504 billion. Now, on an annualized rate, that's about 540 billion, so it's about 13 or 14% off of where we were in 2017. But what's the takeaway there in terms of the amount of trade that we're still doing with China and the amount of stuff that American consumers are still buying from China? What does that say?
It's continuing to grow.
That's exactly right. It means that American consumers' demand for Chinese-made goods is still very strong, despite the Trump tariff war, the Trump trade war. Not much changed is the point, okay? Now, this chart here shows us what? It shows us another aspect of international trade, which is the importance of relationships. And so you see that you've got North America here, the groupings, and you've got North America, you've got Asia, and you've got Europe. And so in the last administration, we saw efforts by the administration to alienate all of our allies, alienate our long-term trading partners, and to warm up to folks who are not our allies, who are not our key trading partners. And what have we learned from that? What we've learned from that is that that's very problematic for the United States, that the United States needs its alliances around the world, that global trade relies upon a variety of tools. For example, China has a variety of tariffs and non-tariff barriers that it uses to prevent American goods, American services, and American agricultural products from coming into the country. Yes? And that from coming into the country and reaching Chinese consumers who would like more of American goods, more of American agricultural products, and more of American services, right? And so the U.S. needs to use a combination of tools, soft power and hard power, in order to advance its trade objectives in Asia. One of those is interacting directly with China, with whom we have both a competitive, adversarial, and cooperative relationship, and also asserting ourselves more forcefully in the region. The way that we had done that under the previous administration, before the Trump administration, was to negotiate what was a sweeping agreement, the Trans-Pacific Partnership, that would have accomplished all of the things that we need to do in Asia in terms of establishing the U.S. Footprint in Asia and making American goods, agricultural products, and services much more available throughout the region. In the absence of that, all of those tariffs, those thousands of tariffs, are still in place, and the barriers to entry in countries like Vietnam and Malaysia and others still remains very high. Are there any questions on this analysis here? Okay, if not, I'm going to move on. Now here, we talk about three different types of groupings of countries. We talk about frontier markets, which are developing countries which are more developed than the least developed countries, but too small to be considered an emerging market. Those are countries like Argentina, Croatia, Kenya, Bahrain, Bangladesh. Next, we consider emerging markets, where you see some degree of liquidity in the local debt and equity markets. You see some type of market exchange, some type of regulatory body, and a move towards a more advanced economy.
Why is China still considered an emerging market, considering the fact that they're the second biggest economy in the world?
That's a good question. That's a good question. That's a very good question. Why do you think China would be considered an emerging market still?
Is it because of the type of government they have?
Because their population is enormous.
Well, it's not because of this. I think that's a good idea. I don't know that it's because of the size of the population. I think it has to do with market access, market transparency, market liquidity. I think it has to do with the per capita income of the country. It's a very good question and prescient, because I pulled out some material that I like to use from Morgan Stanley on the next slide. Let's hold off on that for a moment. On the emerging market, from emerging markets, we look at, of course, more developed markets, where you see high income, openness to foreign investment, ease of capital movement, and market efficiency. Countries like Canada, Sweden, Japan, New Zealand, Singapore, and of course, the United States. These are the most developed in terms of the economy and capital markets. If you look here at the Morgan Stanley Capital International, this is a widely used reference guide. They divide the world's markets into developed, emerging, and frontier. And you'll notice that you see Brazil, China, and India also noted here as emerging market countries. And I note here why. It's because of market size, it's because of liquidity, accessibility, foreign ownership, and per capita income. Those are the reasons most often cited as to why China and India remain considered emerging markets. Okay? Okay, so at the same time, China is considered an emerging market, but what? 20 years ago, China had none of the top 20 tech firms by market cap. But 5 years ago, it had 2 of 20, and today it has 9 of the top 20 tech firms by market cap, which I've listed for you here, right? And so we see that tech innovations drive comparative advantage and affect patterns of trade. So after World War II, the Japanese were very labor intensive. And what would have made sense for them to do in terms of developing their comparative advantage would have been to do what after World War II?
You said Japan?
I said Japan after World War II that had been decimated by World War II. I'm seeing it how your history is. After World War II, they're decimated. They're trying to rebuild the economy. They have a comparative advantage. They have a lot of labor. What should they have gone into based upon their comparative advantage?
In trade.
Technology.
They should have gone to labor-intensive industry. What would be a labor-intensive industry? Something
Construction?
Manufacturing?
I'm thinking more along the lines of agriculture after the devastation of World War II, where the economy of Japan had been really wiped out. There was no capacity for anything, no industrial capacity, but they had a lot of labor. Well, farming would have been a good thing for them to go into. But what did they do? They spent all their money developing what?
Technology.
They spent all their money developing their technology prowess. That's exactly right. They developed their comparative advantage. The government of Japan made a conscious effort to develop their comparative advantage that was not in line with what their natural comparative advantage was, which was an intensity of labor. They were labor intensive. And they developed technology prowess, much like India did many years later in the 1990s, to become a destination for outsourced work, developing the technology hubs that we now know so well in India. So that's very good. Excellent answer. That's exactly right. So again, we see how comparative advantage can affect patterns of trade, much like we see here with China over the course of the last 2 decades, and certainly Japan after World War II, that became a leader in electronics, consumer electronics, during the 1970s and 80s. Excuse me. And so, yep, go ahead, please.
Could you speak more to why you believe? Well, firstly, could you speak more to why they were so labor intensive, and secondly, why you think that they should have gone into agriculture as opposed to technology or perhaps auto manufacturing?
Because they didn't have a natural disposition for technology. The country had been wiped out by Hiroshima and Nagasaki, nuclear explosions. What they were left with was less people, but they still had a lot of people. They were avid rice farmers. They had arable land that they could farm. They had to spend years developing and investing in their technology sector, building out their capacity in order to become competitive, much like India did with developing its technology infrastructure, developing a labor force that was able to address not only outsourced blue-collar work, but white-collar work. Increasingly, we're seeing more and more of India's technology workforce servicing, really, solid white-collar work, whether it's accounting or actuarial work or finance work, software development. There's really no limit to what can be done or what can be outsourced. So that's a long answer to a short question, but yes, after World War II, Japan made a conscious effort to develop what was not a natural comparative advantage for it.
I'm by no means capable of running a country, but if I were to try to understand where they were coming from, I mean, maybe perhaps they were thinking longer term. Would you say that agriculture is more short-sighted and maybe technology was longer-sighted? Or
well, of course you're right. Of course you're right. They had a long-term view. They had an incrementalist view. They had a long-term perspective. That's exactly right. Of what could be accomplished. In other words, they were broke. They were devastated. The best way to make money is to grow food and sell it. You don't have any. They had nothing else. And so you're right. This was a short-term view. They invested over the long term, and there we have it. Yes.
Was it isn't Japan's size is pretty small, and also after dropping the bombs, the land becomes radioactive. They can't just go on and start farming because they would be eating radioactive waste. At
Well,
that
of
point, I
course,
think
in Nagasaki and Hiroshima, yes, but that didn't cover the entire country. And um, uh, we assess countries based upon the size of the labor force. So, example, China is a labor-intensive country. The U.S. is a capital-intensive country relative to one another. After World War II and the devastation of World War II, Japan's comparative advantage was in its labor force relative to anything else. And what could that labor force do? It could farm. And with that, I'm going to move on to our next slide because I'm mindful of the time. So here, what do we see? We have the price of copper, okay? And so the price of copper is an interesting tool to assess the direction of the global economy. Why? Because it's a global indicator of which China is the largest consumer. And as I point out here, it's got broad use in cyclical industries from construction to cars. And we know that whenever China's demand is increasing, it's expected to grow. We know that the expectation is that the economy will grow. So what's happened here? While the rest of the global economy has contracted significantly, what happened in March 2020? My last class at Baruch was March 9th. The schools closed on March 11th. And we started to go all full-time online. So since March 2020, what's happened to the price of copper? The price of copper has risen dramatically. And why is it? When everyone else is slowing down, China's demand is increasing. Why is China's demand increasing?
Well, for those that don't know, copper is it's a base metal that's used in a lot of newer technology, right? It's used in semiconductor technology. It's used in homes to power homes because of it's conducive to electricity. It's used in a variety of like advanced society tech. And so as China began to recover, it began to buy up more copper. It generally has large inventories of copper, and it continued to buy more because their economy was recovering, and they're poised to continue to grow, right?
And their expectation is that they're going to continue to grow and that global demand will pick up as the vaccine becomes more widely available. Is that right?
Yes.
Well, so then that's an excellent answer. Luis, right?
Louis,
pardon me, excuse me. If I mispronounce someone's name, you've got to tell me. Thank you. That's a great answer. And yes, he's exactly right about the importance of copper as a global indicator and its role in China's economy. So another bellwether for the global economy, and one that I've been keeping an eye on and that you should add to your list of global indicators. We take a look at the price of copper over the course of the last 20 years, and you see what? That before each great downturn, whether it was a dot-com recession in 2001, the Great Recession in 2007, or the global pandemic-driven recession in 2020, we see that the price of copper falls precipitously before each one of these recessions.
isn't that because of expectations of consumptions in like tangible technology products?
I'm sorry?
Isn't that because of expectations of consumption?
The expectation of consumption, well, that's exactly right. Before the dot-com boom, the expectation of consumption was that it was slowing. That global consumption was slowing, and we saw a fall off in the price of copper just before the dot-com recession. We saw a fall off in the price of copper just before the Great Recession in 2007, and then, of course, again, right before the global pandemic. So, of course, yes, it's about an expectation of demand. Because China expects an increase in demand, we see the increase, we see the price of copper being bid up. Here, would I buy copper as a hedge against gold?
can I chime in?
Yes.
Being that copper is a more or less, it's not quite as like if I were to think about a commodity, an inflation hedge, I would think about, yeah, generally speaking, you do use commodities as an inflation hedge because they're not directly correlated to, for example, in the equity market, right? But I personally wouldn't use copper as an inflation hedge because it's not quite as sought out. That's just my personal opinion. I covered copper and lithium extensively last semester, and I am bullish on it, but I don't know that I would use it as an inflation hedge. Professor, you might have a different perspective.
I think that's an interesting perspective. I haven't given it much thought. Gold is a standard inflation hedge that people like, and one that I've bought before over the years. I'm not a big believer in buying gold, but in terms of an effective inflation hedge, I haven't really given much consider to buying copper. My view on copper is a global indicator of which China is the biggest buyer. It's one of many barometers that we consider as we try to assess global risk. Any significant fall off in the price of copper is going to signal an anticipation of falling demand. That's the key takeaway here. If we look at key market data, I provided you with links on Blackboard to key market data that's not going to cost you any money, so you don't need to have a Bloomberg subscription or any other type of subscription. So let's take a look here through the various market data that's coming out this week. We see here on Monday, today we got the market manufacturing PMI, which is the producer managers index. We got the Institute of Supply Managers Manufacturing Index, and we got construction numbers. Any reading over 50 signals expansion. Any reading less than 50 with the PMI numbers or ISM numbers signals a contraction. Okay, these are composite indexes of US manufacturing, the first two numbers. And you see both of them are high. They're well above 50 at 58.7 and 59.2% respectively. Construction spending you see is also up in December. And so the point I make here, what's the takeaway from this data, is that we see improving conditions. We've seen here the strongest recovery in factory activity since January 2019 in these last numbers. That's, of course, very positive. And supports what? The comment that we made earlier with regard to the U.S. housing industry. While there's weakness in our service sectors as a result of the pandemic, the home buying sector and everything that feeds into the home buying sector, of course, is doing very well. Anything to do with construction, anything to do with all the various goods and products that go into a home are doing well. And so, therefore, you're seeing improving conditions. The drag on the economy is what? Any type of delay with regard to mass vaccination and achieving herd immunity. That's the drag on the economy now, which is exactly what Jerome Powell spoke about last week. Tomorrow's numbers, that's important, we're going to get the home ownership number. The home ownership number is a very important barometer for the strength of the economy. For most people, their home is their single biggest asset. It's also the single biggest component of their net worth. The higher the home ownership rate, the higher the cumulative net worth of the citizens of the country. So if you look at home ownership since the late 1960s, what do you see? You see that home ownership was pretty stable here in the 60s through the 70s and 80s. And in the 90s, we see tremendous growth in home ownership. Well, who was president in most of the 1990s? Can anyone tell me?
Bill Clinton.
Bill Clinton was president most of the 1990s. We saw the biggest expansion of economic growth in the late 1990s that we had seen since the end of World War II under Bill Clinton, with peak economic growth in the late 1990s, which led to or triggered or catalyzed tremendous home purchasing here in the home buying here in the United States. So home ownership soared. What happened after that? Well, we had a series of crises. We had the attacks on 9/11. We had the dot-com bust. We had the Great Recession in 2007. All of these things led to a contraction in home ownership. You see that since the end of the Great Recession and since 2014 or 15, we've seen a recovery in home ownership as the economy has continued to continue to recover. Obviously now, as the result of COVID, we're seeing more and more interest in homes outside of cities, which we talked about earlier in the session. On Wednesday, we're going to see the all-important ADP employment report. That's, as you see here, I point out that it's based on payroll data about 400,000 firms. It represents about 25 million NAICS employees. NAICS is the North American Industrial Classification System, and that includes all of the industries that I've listed here. You'll see from agricultural, forest, fishing, and hunting, all the way down to public administration, professional, scientific, and technical services. So the ADP employment report covers 25 million people in these various 25 million employees in these various industries. So we've got home ownership tomorrow. We've got an employment report on Wednesday. On Thursday, we've got very important initial jobless claims, and we've got continuing jobless claims. Those are two very important numbers. You'll notice here that with initial jobless claims, we're running about 850,000 jobs a month. Those numbers are huge. During the Great Recession, when Barack Obama became the president, he came into office in January of 2009. In January of 2009, we were hemorrhaging jobs at the rate of 800,000 jobs a month. Now, that was considered extraordinary. That was before we saw a job loss of 22 million jobs, which we saw in the month of March and April of this past year, of 22 million jobs. If you notice here, in January, just by a point of comparison, we saw jobless claims of 212,000. This was when unemployment was at a 50-year low of 3.5%, just before the crisis began, okay? And so continuing jobless claims, which now are at were last month at 4.77 million. In January, we're at under 2 million. To just give you an idea of the scale of the crisis brought on by the pandemic. On Friday, we have the more important non-farm payroll numbers and the unemployment rate. The first Friday of every month is when we get unemployment numbers. That's an important thing to remember. The first Friday of every month is when we get the important employment figures, the payrolls number and the unemployment rate. And you'll see here that the payroll number in January was, we added 214,000 jobs. Last month, we lost 140,000 jobs. The unemployment rate in January was 3.5%, which I point out here was at 50-year lows. The unemployment rate last month was 6.7%. The trade deficit in January was 42 billion. The trade deficit has widened to 68 billion since then on a monthly basis. Now, if you notice here, I point out that non-farm payrolls, as opposed to the ADP employment report, is based on 60,000 households, which surveys about 80% of the US workforce, as opposed to 25 million NAICS employees. The size of the US workforce was at its peak about 160 million people. So 80% of the US workforce is a pretty significant number. Are there any questions on this? Where? Because that data is not coming out this week. This is just the data that's coming out this week. And if you look at the information I gave you online, I gave you this access to this MarketWatch information, okay? And so if you see here at the top on Monday, the actual numbers are filled in. Tomorrow we'll get all, and each subsequent day we'll get all the numbers filled in, and we'll be able to look at this completed economic summary sheet here fully next week. But again, payroll numbers come in at the beginning of the month, and we're going to keep an eye on that as we move forward. I wanted to take a moment here. If you look here, the last data point we looked at was the trade deficit. One of the things that Trump talked about was to reduce our trade deficit. As you notice, our trade deficit has only gotten bigger, despite that trade war that he said would be easy to win, which you've already said we know is not true. So what do you see here? What pattern do you see here over the course of the last 20 some odd years with regard to the U.S. trade deficit? This is the U.S. trade deficit on a monthly basis. You
Increasing
see that
pattern.
it's increasing. It continues to increase, right? It continues to increase. That's exactly right. Thank you. So what's happening here in the early 2000s? Well, China is joining the World Trade Organization, and U.S. is beginning a massive policy of outsourcing all sorts of production, all sorts of manufacturing overseas. We see 7.5 million jobs outsourced abroad, and the U.S. U.S. trade picks up enormously during those years, as does our trade deficit. We see the same thing again after the depths of the Great Recession, following the depths of the Great Recession, that the trade deficit has persistently risen. And we get back to the idea of the US dollar. The US dollar is the world's reserves currency. And so therefore it has a unique position in the global currency markets. What does that tend to do to the inherent value of the US dollar? Increase it or decrease it?
Decrease it.
Decrease, yeah.
Okay, let's try that again. The strength of the US dollar as a reserve currency. So we see that the very high savings rate in China leads to a massive flow of capital into the US markets, into the US Treasury markets, driving interest rates lower, making it easier over the last 20 years for businesses and consumers to borrow at very, very low rates, right? And so what happened, the US dollar as the reserve currency, what does that do to the value of as the reserve currency? Is that a strengthening aspect of the currency or a weakening aspect of the currency?
This is because it gives you is increasing.
Should be
It
strengthening
strengthens the
and
currency. It makes the US dollar stronger.
Easy to
makes
import.
the US dollar, pardon me?
Easy to import.
It makes the US dollar more competitive. It makes the US dollar stronger. It makes it easier to import. It makes it harder to export. So my argument is that the unique role of the dollar makes it almost impossible for the US to do anything other than to run a deficit. That, paired with our historically low savings rates, makes it very hard for the US to run anything but a trade deficit. And while I don't want to go into a whole long discussion about trade deficits today, the simple fact is that a trade deficit on its own really doesn't matter. A bilateral trade deficit China really doesn't matter very much in the long run. But I'm not going to talk about that in any great detail today. We'll get back to trade deficits later. I'd like to move on. If you see here, you have the dollar index, which is the dollar against a basket of 6 currencies, right? So this is the geometric mean of the dollar foreign exchange rate against a 6 currency basket that represents the US's major trading partners. It's been around since 1973. And you see it includes the European Union, Japan, the UK, which is no longer a member of the EU, Canada, Sweden, and Switzerland. And the big takeaway here is that, again, the US dollar remains persistently strong. And we see that against a basket of 6 currencies of our major trading partners over the long term. And that's because of the reasons that I've mentioned. So here we see what's happened on a more specific level with regard to the global pandemic in terms of a contraction of demand. And we see what's happened over the course of the first couple of quarters of 2020. And we see here that countries that are particularly dependent upon what? UK, Spain, Portugal, France, Italy, Belgium, the EU, countries that are particularly dependent on what type of industry saw a significant contraction during the second quarter of 2020 while the pandemic
Tourism.
really began to rage. Who said that? Lynn. Tourism.
Yes.
That's exactly right. That's exactly right. So nations with more exposure to tourism and travel experienced larger coronavirus-related GDP decline. That's very good. Thank you. If you look at the US here, what do you see? You see that the contraction in the second quarter was 9.5%. Annualized, that's a 33% decrease. That's the largest GDP decrease on record. That includes the Great Depression of the 1930s, right? So what do we see? That the pandemic has severely impacted global trade. We see lower domestic demand, and spending on consumer investment goods are obviously been cut with lockdowns. Countries that are more involved in the services sector countries that have more businesses involved in tourism obviously have had a much harder time than others. Excuse me. I'm mindful of the time. I know we have about 12 minutes left. Is that right? What time does this class end? Pardon me?
8:45.
8:45. Well, then good. We've got a good 12 minutes left. So here, let's take a look more. We've looked at demand contraction during the last, over the course of the last year. And what do we see here? We see here job growth. And as we pointed out before, you see that in the first 2 months of the COVID crisis, we lost more than 22 million jobs, right? And that's an unprecedented loss in jobs, which has triggered an enormous economic crisis here in the United States, felt by many, as we all know. Here we see, I can't see the top of this.
When you
Initial jobless claims.
Initial jobless claims.
Jobless claims. So see, we see that initial jobless claims. Excuse me. We see initial jobless claims. We see initial jobless claims explode with the coronavirus. Yes, and they've begun to taper off, but as you can see, they remain jobless claims, as we said before, remain very high. We're running 800,000 jobless claims on a regular basis. That's just the numbers are staggering. If you look here, tell me what the top of the page here. This is the unemployment rate, right? So we saw the unemployment rate that began the year when I was teaching this class last semester. We started the year off saying, look at this, the unemployment rate's at historic lows. So what happened? The unemployment rate exploded as a result of this uncontrolled health crisis. Yes? That's of course moderated as jobs have been. That's of course moderated and been reduced as there's been some job recovery. Let's remember though, there hasn't really been much job creation. What has there been? There's been lots of workers that have furloughed that have been brought back on. Yes, but there's still a shortfall in the overall job market. Here you see continuing claims. You see that, in other words, continuing ongoing unemployment claims that peaked at almost 25 million, and now, of course, have tapered off as more people have been reabsorbed back into the market. But what do you see? You see that the job market has contracted from just under 160 million to about 150 some odd million. So we're still short about 10 or so million jobs in the labor market than where we were pre-pandemic, right? So this chart shows you two things. It shows you the longest period of uninterrupted job growth in U.S. history that began in the administration, the Obama administration, as a response to the global pandemic. It's worth noting that the head of the Federal Reserve at the time, Janet Yellen, has just been named the Treasury Secretary. I, for one, am particularly optimistic that she is in charge of the Treasury, given her long history of success helping to steer us out of the Great Recession at the Federal Reserve, at the top of the Federal Reserve. And also the fact that a constant labor market that followed the Great Recession, the constant labor market growth, that what accompanied that was very little inflation. Why is that important? It's important because the historic assumption is that if you have very strong economic growth, what are you going to see? You're going to see strong inflation. And we didn't see any inflation. We saw an accommodative Treasury, we saw an accommodative Federal Reserve, and we saw an accommodative Federal Reserve and an accommodative fiscal policy. And what did we see in terms of inflation? This is inflation. We see inflation that has been persistently below 3% since 2012, right? In some cases, even struggling to get above 0%. Yes, so inflation has been very low, even though we've seen strong growth in the job market.
Professor?
Yeah.
We actually do see the inflation, but we see it on the stock market.
We do see inflation in the stock market, but yes, I'm talking about price inflation on goods. But yes, you're right. We see inflation on the stock market. Oh boy, we got a lot to do. Once demand picks up, what are they going to do in the money? Once demand picks up, well, if there's any sign of inflation, the Fed has made clear they're not going to preemptively raise rates before their 2% target. They're going to give plenty of room to run to reach a 2% inflation rate, and then decide whether or not to raise rates. In terms of what they're going to do with printing money, obviously, the expectation is that the economy recovers, demand, pent-up demand will be unleashed as vaccines permeate our entire country. We achieve herd immunity. The full expectation is that the Fed will wind up its bond buying program and will slowly but surely, inexorably raise interest rates. But we're well away from that. We've got quite a while to run before we're anywhere near there. That's for sure. I'm going to jump ahead here. We're not going to have enough time to get to all of my slides tonight. I want to jump down to the bottom, and I want to talk about the class. Okay, before we break. I'm going to do this. I'm going to post for you after class tonight's slideshow, including the slides that I didn't do. I wanted to talk to you about the VIX volatility index and a few other items that I introduced, another few data points. I'm showing you domestic data points. Take a look at those before class on Wednesday, and we'll pick up class on Wednesday directly there with the VIX index. In terms of the class structure, I made for you a list here of the material in the class that we're going to cover. As I said, we start with capital markets review. We make our way through foundations of modern trade theory, tariffs, regional trading relationship, factor movements, the multinational enterprise, direct foreign investment, and country risk. And finally, we'll do foreign exchange and managing and hedging risk. And we'll work with derivatives. We'll do some currency arbitrage, work with puts and calls and swaptions and straddles and a variety of hedging techniques that I'll run through with you at the end of the in our last segment of the semester. Yeah, we're going to do a whole bunch of options. Sure, we will. I'm going to do that's our last section. It's a fun section. And we're going to look at how companies hedge their risk in the global capital markets. How do they put on money market hedges? How do they use call options and put options to hedge their accounts payable and accounts receivable risk? What are the various techniques, straddles and strangles that companies can use to insulate their risk in order to minimize their cost and maximize or optimize their return? If you look here, we talk about assignments and grading. You're going to have 3 exams, a midterm, a final, and a quiz. Everything is very straightforward. I'm available to you throughout the semester. I will give you all the information you need to do well in the class, and a resource that's available to you. Whether we're in school physically or online, my experience is teaching here at Baruch now for quite a few years is that when students work with me directly, if there's anything challenging about the material, they do well. If you don't keep up, you don't come to me with questions if things arise, if you don't follow up, then there's a chance that you won't do well. That being said, my experience has also been that the students I work with are exceptional. Everyone works very hard, and together we have a good time. I'm eager to meet all of you, to learn from you, and I'm available to you. So if any questions come up between now and Wednesday, please shoot me an email. Otherwise, I'm wishing you all of you a very good, safe continuation of the evening. I'm happy to meet you. Thank you for coming, and I'll see you on Wednesday. Okay?
Thanks, Professor.
If you check, just hold on before we all say goodbye. If you check Blackboard in the next hour or so, or tomorrow morning, if that's easier for you, you'll see the slideshow on there. Have a look at it, and we'll start.